This video is about momentum investing. Hello, I'm Peter Martin with Trading 212. Now in this series of videos about investing, we've talked in the past about value investing, the idea of looking at price relative to some other measure, say earnings or book value, in order to identify companies that have been overlooked or undervalued by the market, and then investing in those companies in the hopes that the value of the company will be recognized by the market at some point in the future. The price will go up and you'll be able to sell your investment at a profit. Now, momentum investing differs from value investing in a number of key ways. A momentum investor is not dissuaded by a high price or a rising price. In fact, they will be attracted to a company that's price has been rising in the hopes that the upward trajectory will give the stock momentum, as the name of the strategy suggests, to keep on moving in the same direction for some period of time in the future. So a momentum investor is not looking for a company to have a turnaround in fortunes in terms of price. A momentum investor instead is looking to jump on a stock that's been moving in one direction recently in the hopes that it will continue in that same direction in the future. So we could sum up in a way value investing as buy low and sell high, and we might sum up momentum investing as buy high, sell higher. Now, the whole strategy hinges upon the momentum effect, which when it comes to stock investing is a phenomenon, or some would say an anomaly, by which companies that have outperformed relative to their peers have a tendency to outperform in the future going forward. And similarly, companies, stocks that have underperformed relative to their peers have a tendency to underperform going forward. Now, there's quite a bit of academic research that's been done in this area, and there are a number of studies that have observed some statistical evidence in favour of the effect over the periods of which the markets were being studied. So there's a few things just to note there. Some statistical evidence in favour doesn't mean that this is an effect that always exists. It's not a free lunch, and over the periods of which they're being studied, that could be periods of decades, 20, 30, 40 years, and there could be long stretches when this effect was not being observed in that time. And of course, the periods when they were being studied doesn't say anything about the future. The future, as always, is uncertain, and there's nothing to say that because this effect was observed in the past that it will necessarily continue in the future. So what are some possible explanations for why there might be this momentum effect? Well, one suggestion is that it might be a slow or staggered response by the market to new information. And this is why the momentum effect is sometimes described as being an anomaly, because a slow response of the market to new information flies in the face of the efficient market hypothesis. The efficient market hypothesis says that price will react immediately to any new information. But what we're saying here is that, say for example, a company reports better than expected earnings that pushes the share price higher. What we're seeing is that the market responds slowly to this. So that maybe institutional investors respond more quickly to that new information coming into the market. More casual investors respond more slowly, so that we see an initial price movement higher, but then that price continues to move higher on the back of the same information over a period of time. Another suggestion is that it may be due to the disposition effect. Now, the disposition effect is a tendency of investors to want to lock in profits and to hold on to losing positions. It's a bit of an irrational behaviour. If we consider the same example of a company that's reported better than expected earnings, the disposition effect says that those who are long the stock may want to immediately lock in their profits by selling the stock, which creates a bit of a headwind to the stock where it should be moving higher in response to that information. And conversely, if we consider a company that's reported worse than expected earnings, the disposition effect will have people trying to hold on to their losing positions, which can help to prop up the price in the short term, so that we see an initial downward pressure from the poor earnings, but it's sheltered by some degree by people trying to hold on to their losing positions. Eventually they get forced out and the stock continues moving in the same direction. Now, what kind of time frames are we talking about when it comes to momentum investing? Well, it's a shorter term strategy than when we're talking about value investing, the buy and hold approach, the Warren Buffett type of approach to investing. Buy and hold, you might typically be looking at holding onto a stock for a number of years, whereas a standard time frame that's often bandied around for momentum investing is to look at stocks, how they performed over the prior 6 to 12 months, and then to use that as your basis for which stocks to buy, in the hopes that you will see the momentum effect over the next 6 to 12 months. So that's just a quick introduction to momentum investing. If you enjoyed the video, please hit the thumbs up button and give us a like, or if you've got any thoughts on the subject, why not share them with us in the comments section? We do read each one. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.